Most people believe their money is simply evolving. New technology, digital payments, faster transfers. It feels like progress. But something much quieter is happening beneath the surface of the financial system. Your money is not just evolving. It is being replaced, not overnight, not through a public announcement, not through a moment anyone clearly remembers. The change is happening gradually, inside the architecture of the financial system itself. And once you understand how that replacement works, the idea of owning money begins to look very different. Because the form of money most people use today is not the same form that existed only a generation ago. And the system that governs it has been quietly shifting for decades. This is not a story about technology alone. It is a story about structure. About how financial systems evolve when debt grows, currencies stretch beyond their original design, and institutions begin redesigning the infrastructure that holds everything together. Money rarely disappears dramatically. In history, it is usually replaced. Slowly, quietly, sometimes so quietly that people continue using the new system long before they realize the old one is gone. The first thing that begins to change is not the currency itself. It is the role of the banks. In earlier monetary systems, banks were primarily intermediaries. They held deposits. They facilitated payments. They extended credit. But the money itself still existed outside the banking system. Gold coins, silver coins, physical currency backed by tangible reserves. Even paper money originally represented a claim on something physical held somewhere else. If people lost confidence in the system, they could withdraw their money in another form. The currency could still exist outside the banking structure. That distinction was critical, because it meant the financial system depended on public trust, but it did not completely control the form of money itself. Over time, that distinction began to disappear. The transition began gradually during the 20th century as governments and financial institutions moved away from commodity-backed currencies toward fiat systems. Fiat money is fundamentally different from earlier forms of currency. Its value is not tied to a physical reserve. It exists because the financial system recognizes it, because institutions accept it, because the system itself sustains its value. Once money became fully integrated into the banking system, its structure began to change. Money increasingly existed not as something held, but as something recorded. Balances inside accounts, numbers inside ledgers, claims within financial networks. At first, this shift appeared convenient. Electronic banking made payments faster. Digital systems reduced the need for physical currency. Financial markets expanded. But the deeper consequence was subtle. Money became inseparable from the infrastructure that manages it. And that infrastructure belongs to institutions. This means access to money increasingly depends on systems designed and controlled by banks, payment networks, and regulators. The physical independence of money began to disappear. Gradually, almost invisibly. The transformation accelerated as digital payment systems expanded. Credit cards replaced cash in everyday transactions. Online banking replaced physical branches. Mobile payment platforms connected financial accounts directly to digital networks. Each innovation increased convenience. But each innovation also concentrated control. The money people used no longer existed outside institutional systems. It existed inside them. And when money exists entirely inside infrastructure, the infrastructure defines how it works. This is where the quiet replacement begins. Because the money inside modern financial systems does not behave like traditional money. It behaves like permission. Every digital transaction passes through a network that evaluates it before allowing it to proceed. Fraud detection systems examine spending patterns. Compliance systems screen transactions against regulatory databases. Risk models evaluate account behavior. If everything appears normal, the transaction is approved. If something triggers the system's safeguards, the transaction may pause or fail. From the user's perspective, the experience is simple. The payment works. Or it doesn't. But beneath that simplicity lies a structural shift. Money has become conditional. Its movement depends on approval from systems designed to manage risk, enforce regulation, and protect institutional stability. This shift did not occur through a single decision. It emerged gradually as financial infrastructure evolved. Each layer of oversight added new capabilities. Monitoring, verification, control. None of these developments seemed controversial individually. They addressed legitimate concerns, fraud, financial crime, systemic risk. But collectively, they transformed the nature of money itself. Money became something that exists inside a system of permissions. And once money operates through permission, its form begins to change. Because institutions eventually adapt the currency to match the infrastructure controlling it. This is not unusual in monetary history. When financial systems evolve, currencies evolve with them. Gold gave way to paper. Paper gave way to electronic balances. Electronic balances now give way to programmable financial systems. Each transition reshapes the relationship between individuals and money. And each transition appears gradual while it is happening. But in retrospect, the change becomes obvious. The old form disappears. The new form becomes normal. What people call money has changed. The modern financial system is already preparing for another transition. One that will likely redefine how money operates inside digital infrastructure. The early signals are already visible. Central banks across the world are experimenting with digital currencies issued directly by monetary authorities. These systems are designed to operate entirely within digital networks. They promise efficiency, transparency, and enhanced monetary control, but they also represent a deeper shift. For the first time, money could exist entirely within programmable infrastructure governed directly by institutional systems. The distinction between financial infrastructure and currency itself would disappear. Money would become software. This development is often described as innovation. And in many ways it is. Digital currencies could simplify payments and improve financial inclusion. But they also represent the next stage in a longer structural transition. The gradual replacement of money as an independent asset with money as a controlled system. The implications of that shift are not always obvious at first, because the user experience may remain almost identical. Balances appear on a screen. Payments move digitally. Accounts function normally. But the underlying architecture becomes fundamentally different. Money becomes something the system administers rather than something people simply hold. Access can be monitored. Conditions can be applied. Policies can be implemented directly through the currency itself. None of this requires dramatic announcements. Financial systems rarely change that way. Instead, infrastructure evolves quietly. New payment systems appear. Regulatory frameworks expand. Digital platforms integrate with banking networks. And gradually the new architecture replaces the old one. By the time the transition becomes obvious, the system has already moved forward. This pattern has appeared repeatedly throughout monetary history. Currencies rarely collapse overnight. They are replaced. Sometimes because inflation erodes their value. Sometimes because new financial systems make older ones obsolete. Sometimes because institutions redesign the infrastructure that supports them. But the replacement process tends to follow the same pattern. Slow adjustments. Structural shifts. Quiet transitions that accumulate over time. Most people continue using the system without noticing how much it has changed, because the interface remains familiar. The balance still appears. Payments still move. The language of money remains the same. But the structure underneath it becomes something new. If you want to understand how hidden financial mechanisms like this shape the system before they become obvious to everyone, consider subscribing. Because most people only begin noticing these shifts long after the system has already changed. The gradual replacement of money does not necessarily mean sudden disruption. Financial systems are designed to evolve without destabilizing the economy. But gradual change can still produce profound consequences. When money becomes fully integrated into institutional infrastructure, the balance of power inside the financial system shifts. Control over the currency moves closer to the institutions managing the network. Individual autonomy becomes more dependent on access to that network. This does not mean individuals lose all financial freedom, but the structure of that freedom changes. Ownership becomes intertwined with permission. Participation in the system becomes necessary to use the currency. Over time, the line between money and the system controlling it becomes difficult to separate. And that is where the quiet replacement becomes visible, not through a single event, but through a series of small realizations. The payment that requires verification. The transaction that pauses unexpectedly. The account activity that triggers review. Each moment reveals a small piece of the system's architecture. A reminder that money now operates inside infrastructure rather than outside it, and infrastructure always has operators. Banks, payment networks, regulatory authorities, technology platforms managing digital transactions. Together they form the environment in which modern money exists. The replacement of money is not necessarily malicious. In many cases, it emerges from attempts to improve efficiency and stability, but structural changes rarely remain neutral. They reshape the relationship between institutions and individuals. And once those relationships change, the financial system begins operating under a new set of assumptions. Assumptions that may take years for most people to fully recognize. The currency still carries the same name. The balance still appears in the same way, but the underlying system has evolved into something new. Money is no longer simply something held. It is something administered, something evaluated, something permitted to move within a network designed to manage it, and that network continues evolving. Quietly, without announcements, replacing the old structure piece by piece until the new one becomes the only system anyone remembers. Have you ever experienced a moment when your bank or payment system suddenly restricted or delayed access to your money without clearly explaining why? Pinned comment suggestion. Have you ever had a transaction declined, delayed, or reviewed by your bank without a clear explanation? I'm curious how often this actually happens to people.